$1 million sounds like a number that belongs to someone else, someone luckier, someone who started earlier, someone with a higher income, someone with connections you do not have. But the math of compounding does not care about any of those things. And the numbers I am about to show you will make that clear in a way that no amount of motivation ever could. Today, I want to give you the complete honest picture of what building $1 million actually looks like, how long it actually takes, what it actually requires, and why the people who get there quietly are almost never doing what the loudest finance channels are telling you to do. Let me start with the most important number in this entire video, because everything else builds from it, and it is the one number that most people who fail to build significant wealth never truly internalize. The S&P 500 has returned approximately 4% annually on average since 1965, and approximately 4% annually after adjusting for inflation over that same period. Those two numbers, 4% nominal and 4% real, are the foundation of every realistic wealth projection I am about to show you, and they are based on nearly 6 decades of actual market data rather than optimistic assumptions. In 2026 specifically, with the CAPE ratio at elevated levels and stagflation pressures present, a more conservative forward return expectation of 7 to 8% nominal is probably more realistic for the next decade, and I am going to use 7% as my base case throughout this video to give you honest projections rather than flattering ones. Here is what 7% annual compounding actually produces over time when you invest $500 every single month with nothing to start. After 10 years, you have contributed $60,000 of your own money, and compounding has grown that to approximately $86,900. After 20 years, you have contributed $120,000, and compounding has grown that to approximately $260,000. After 30 years, you have contributed $180,000, and compounding has grown that to approximately $608,000. After 35 years, you have contributed $210,000, and compounding has grown that to approximately $945,000. After 37 years, you have contributed $222,000, and compounding has crossed the $1 million threshold with a balance of approximately $1,237,000. $1 million from $500 a month at 7% over 37 years, with only $222,000 in contributions, and the remaining $815,000 entirely by compounding returns on previous returns. Now let me show you how dramatically the timeline changes when you increase the monthly contribution, because this is where the mathematics becomes genuinely motivating for anyone who can find ways to save more aggressively in the early years. At $800 per month, at 7%, you cross $1 million in approximately 31 years with roughly $297,600 of your own contributions. At $1,000 a month, at 7%, you cross $1 million in approximately 28 years with roughly $336,000 own contributions. At $1,500 per month, at 7%, you cross $1 million in approximately 24 years with roughly $432,000 own contributions. At $2,000 per month, at 7%, you cross $1 million in approximately 21 years with roughly $504,000 own contributions. Every additional $500 per month, you can find cuts approximately 5 to 7 years off the timeline to $1 million, which means the question of whether to increase your savings rate deserves serious regular attention rather than just an annual glance at a retirement calculator. Now, let me show you the flip side of this math, because I want to be completely honest with you about the cost of starting late, because the rule of 72 is the single most important mathematical concept in personal finance, and almost nobody teaches it clearly. The rule of 72 says divide 72 by your expected annual return, and that tells you how many years it takes your money to double. At 7% return, your money doubles every 3 years. At 8%, it doubles every 9 years. At 10%, it doubles every 2 years. That means $10,000 in dollars invested at age 25 at 7% becomes approximately $20,000 age 65. The exact same $10,000 in dollars invested at age 35 at the same 7% only reaches $80,000 because it has one fewer doubling period, and that single missed doubling is worth exactly $80,000. This is the invisible cost of waiting, and it compounds just as relentlessly as the returns themselves, which is why the most important wealth-building decision most people will ever make is simply the decision to start. Now I want to address something that I think deserves complete honesty, because most videos about building $1 million skip it, and the omission sets people up for frustration when reality does not match the projection. These numbers assume consistent annual returns of 7%, but real markets do not deliver smooth annual returns, and the sequence in which those returns arrive matters enormously for your actual outcome. If you invest $500 a month for 37 years and the market delivers 7% average annual returns, but delivers those returns in a different sequence than assumed, your actual outcome can vary by hundreds of thousands of dollars even with the exact same average return. This is called sequence of returns risk, and it is one of the most important and least discussed concepts in long-term wealth building. A severe market crash in your early accumulation years actually helps you, because you are buying more shares at lower prices through your regular contributions, which is exactly why dollar cost averaging during a crash is so powerful. A severe market crash in the final 5 years before you reach your $1 million goal, or immediately after you stop contributing and start withdrawing, can permanently impair your outcome, even if the average return over the full period is identical. This is not an argument against investing. It is an argument for understanding the mechanics clearly so you can structure your approach to minimize the damage from bad luck in the sequence of returns. The Fortress balance sheet we discussed in video 4, meaning 3 to 6 months of emergency fund plus some cash dry powder, directly addresses sequence of returns risk by ensuring you never have to sell investments at forced valuations during a crash to cover living expenses. Now let me talk about the trend-chasing alternative to the boring path to $1 million, because I think showing you the math on what actually happens to trend chasers makes the case for the boring approach more powerfully than any other argument could. In 2020 and 2021, meme stocks, crypto, and SPAC investments attracted hundreds of billions of dollars from retail investors who were convinced they had found a shortcut to the $1 million outcome. The ARK Innovation Fund, which became the symbol of the 2020 and 2021 growth stock boom, peaked at approximately $159 per share in February 2021 and traded near $53 as of mid-2026, a decline of more than 66% from its peak over 5 years, while the S&P 500 over the same period delivered positive total returns. The investors who moved their boring index fund contributions into ARK in February 2021 because it had returned over 150% in 2020 did not just miss 5 years of market gains. They are still significantly below where they started on that particular investment even 5 years later. Bitcoin, the most famous trend-chasing investment of the era, reached an all-time high of approximately $108,000 in December 2024 and traded near $93,000. Meaning investors who bought near the peak are sitting on roughly a 14% loss, while the boring index fund investors who stayed put have continued compounding through the same period. The average retail investor who chased cryptocurrency between 2020 and 2022, according to data published by Dalbar, lost significantly more money than the broad market index during that period, despite the fact that Bitcoin itself has delivered extraordinary long-term returns because they bought high and sold low with emotional rather than systematic timing. This is the fundamental problem with trend chasing, and it is not unique to crypto or meme stocks. It is the universal behavioral pattern that Dalbar has documented for 3 decades, showing the average retail investor underperforming the S&P 500 by approximately 4% annually purely through behavioral mistakes around timing. 4% per year sounds small until you run the compounding math on it. An investor earning 7% annually for 37 years reaches approximately $1,037,500 per month, as we calculated earlier. An investor earning only 3% annually for the same 37 years from the same $500 per month reaches approximately $356,000, less than 1/3 of what the silent investor built from identical contributions over an identical period. That's $681,000 tax on trend chasing, and it is levied silently over decades on millions of investors who never see it on any single statement, but feel its full weight only at the end of their accumulation period. Now let me give you the specific timeline framework for building $1 million silently in the current 2026 environment, because I want this to be immediately actionable and calibrated to where things actually stand today rather than a generic projection from a different era. In 2026, with the Fed funds rate at 3.50 to 3.75%, high-yield savings accounts paying 4 to 5%, bond yields running around 4%, and equity markets at elevated valuations. The realistic forward return expectation for a diversified, boring portfolio is probably 6 to 8% nominal, rather than the historical 10% average. Using 7% as a conservative but reasonable assumption for the next 15 to 20 years. Here is what your path to $1 million looks like depending on where you are starting from today. Starting from zero with $500 per month, approximately 37 years to $1 million. Starting from 25,000 invested with $500 per month, approximately 33 years to $1 million. The existing capital cuts 4 years off the timeline. Starting from $50,000 already invested with $500 per month, approximately 30 years to $1 million. Starting from 100,000 invested with $500 per month, approximately 26 years to $1 million, because the existing capital is already doing significant compounding work. Starting from $100,000 already invested with $1,000 per month, approximately 21 years to $1 million. Starting from $100,000 already invested with $1,500 per month, approximately 17 years to $1 million. These numbers are honest projections at 7%, not guarantees, and they do not account for taxes on gains within taxable accounts, which is why using tax-advantaged accounts, like a 401k or IRA, for as much of your accumulation as possible materially improves your actual outcome. The 2026 contribution limits are $23,500 per year to a 401k and $7,000 IRA, totaling $30,500 in potential annual tax-advantaged accumulation space per person before accounting for any employer matching contributions. An employer match of even 3% of salary on a $60,000 income adds $1,800 per year in free money that directly accelerates your timeline and represents an immediate 100% return on your contribution that no market investment can match. Capturing your full employer match before doing anything else with discretionary savings is not just good advice. It is mathematically the single highest return action available to almost every employed investor in 2026. Now let me address the specific question that I know a significant portion of people watching this video are asking, which is, what if I am starting at 40 or 45 or 50 and the 37-year timeline feels impossibly discouraging? Starting at 40 with zero savings and $500 per month at 7% gives you approximately $338,000 which is not 1 million, but it is not nothing, and it grows to $490,000 this hits you 15,000,000,000,000,000,000 if you can reach one. Starting at 40 with 50,000 already accumulated and $800 per month at 7% gives you approximately 600,000,065. Starting at 40 with 100,000 already accumulated and 1,000 per month at 7% gives you approximately 870,000,000 within reach of 1 million with modest additional contributions or slightly better than expected returns. The $1 million target is a motivating number, but it is not the only number that matters. What matters is building the largest possible portfolio through systematic, consistent, silent investing, and that process has a meaningful positive outcome at any starting age, even if the specific $1 million milestone requires more time than a later start allows. The key insight I want you to take from those later start numbers is that the variable you have the most control over right now is not your return, which markets will determine, and not your age, which is already fixed, but your monthly contribution rate and your consistency in maintaining it through every market environment regardless of what headlines are doing. Every additional $100 per month you can consistently contribute makes a real measurable difference in your ultimate outcome, and the only way to find those additional hundreds is to apply the same boring, deliberate, methodical thinking to your spending that you apply to your investing. Let me close with the complete picture of what building $1 million silently actually looks like in practice, because I want you to leave this video with a clear, unromantic, fully honest view of the process. You will have years when the market returns 20% and the contributions you made that year grow dramatically and everything feels easy and obvious and you wonder why everyone is not doing this. You will have years when the market falls 30 or 40% and the contributions you made that year decline in value and everything feels wrong, and you wonder if the entire strategy is broken. The answer in both cases is to do the same thing. Make your scheduled contribution, do not change your allocation in response to emotion, rebalance once per year, and move on with the rest of your life. The $1 million outcome is built not in any single dramatic year, but in the accumulation of hundreds of ordinary months where you simply kept the system running and let it do what mathematics designed it to do. That is the complete honest framework for building $1 million silently while everyone else chases trends, gets excited at peaks, panics at bottoms, and ultimately spends decades arriving at destinations far below what boring consistency would have delivered. Start today, stay boring, let the math work, and see you in the next video. Let me add one more dimension to everything we covered today because I think there is a specific 2026 context that makes this video more urgent than it might have been in a different year. Right now, in mid-2026, there are more trend-chasing narratives competing for your savings than at almost any previous point in financial history. AI stocks, energy plays tied to the Strait of Hormuz conflict, gold at all-time highs, Bitcoin near $93,000, real estate in certain markets, and dozens of ETFs built around each of these themes are all competing for the same dollars that boring index fund compounding would be quietly putting to work over 37 years. Every single one of these narratives has a genuine data point behind it that makes it feel compelling in 2026, and every single one of them could absolutely deliver strong returns from current levels. The problem is not whether any particular trend will continue. The problem is whether you as an individual investor will actually capture those returns or whether you will buy at the excitement peak and sell at the fear bottom, as the data consistently shows most retail investors do. The silent millionaire does not avoid all of these assets entirely. We have discussed appropriate small allocations to energy and gold in previous videos, but the silent millionaire never lets any single trend narrative become the dominant force in their portfolio, regardless of how compelling the short-term story sounds. The boring portfolio remains the core. The systematic contributions remain on schedule. The annual rebalancing remains mechanical, and the trend exposure stays capped at whatever defined percentage the framework allows. This discipline, applied consistently across the specific 2026 environment, with its genuine complexities and genuine opportunities, is what separates the investors who quietly cross the $1 million threshold from the investors who perpetually feel like they are one great trade away from getting there. Let me now give you the specific numbers one final time in the clearest possible format, because I want these to be the numbers you remember when you close this video. $500 per month at 7%. $1 million in 37 years, 222,000 contributed, 850,000 by compounding. $1,000 per month at 7%, $1 million in 28 years, 336,000 contributed, 664,000 by compounding. $1,500 per month at 7%, $1 million in 24 years, 432,000 by compounding. $2,000 per month at 7%, $1 million in 21 years, 504,000 by compounding. In every single scenario, compounding creates more wealth than your contributions do, which means the single most important decision you make is not which stock to pick or which trend to follow, but simply how early you start and how consistently you continue. Now, let me address the one question that I deliberately saved for last, because it is the most commonly asked question about building $1 million, and the honest answer is almost never what people want to hear. The question is whether there is a faster path, a smarter strategy, a better asset class, a different sequence of decisions that could get you to $1 million significantly faster than the boring systematic approach I have described today. The honest answer is yes. There are paths that could get you there faster, but they all require taking on meaningfully more risk than the boring approach, and the data on who actually succeeds on those paths versus who fails is not encouraging for most individual investors attempting them. Venture capital investing can produce extraordinary returns, but the majority of venture investments return zero, and success requires deal access, expertise, and capital concentration that most individuals do not have. Real estate investing can accelerate wealth building significantly, particularly with leverage, but it also concentrates risk, requires active management, and can produce catastrophic outcomes in the wrong market or with the wrong leverage level. Individual stock picking can outperform if you have genuine analytical edge, but the data consistently shows that the overwhelming majority of individual investors, including most professional fund managers, fail to beat the index net of fees over long periods. The boring systematic approach is not the fastest theoretical path to $1 million, but it is the most reliable path with the highest probability of actually arriving at the destination rather than overshooting and crashing back or simply running out of runway through a series of expensive mistakes. That reliability, that probability advantage, that near certainty of a meaningful positive outcome given sufficient time and consistency is worth far more than the theoretical upside of a faster but less reliable alternative. This is exactly what the data says. This is what the evidence supports. And this is what the silent wealth builders who actually reach $1 million and beyond have chosen over the excitement of the alternative paths available to them. Choose boring, choose consistent, choose patient, and let the math deliver what it has always delivered to the people disciplined enough to get out of its way. Subscribe for the next video, where we look at how the people who crossed the $1 million threshold in their 40s and 50s actually got there, and the specific behavioral patterns that separated them from the majority who started with similar incomes but never arrived at the same destination. Let me also cover the tax dimension of building $1 million, because it is the piece most projections ignore, and ignoring it means your real outcome will be meaningfully lower than any pre-tax projection suggests. In a taxable brokerage account, you will owe capital gains tax on your investment gains when you sell, and for most investors holding broad index funds for more than 1 year, the long-term capital gains rate is 15% for income between approximately $47,025 and $518,900 in 2026. This means that $1 million in a taxable account is not actually $1 million of spendable wealth, because a portion of those gains will be owed to the government when you realize them. The solution is not to avoid investing in taxable accounts, but to use tax-advantaged accounts first, and to understand that your taxable gains should be allowed to compound as long as possible before triggering a sale. The 401k contribution limit in 2026 is $23,500 per year, allowing that money to grow tax-deferred with no capital gains tax owed until withdrawal. The traditional IRA or Roth IRA limit is $7,000 in 2026, with the Roth version allowing completely tax-free growth if you meet the income eligibility requirements. Prioritizing these tax-advantaged accounts before your taxable brokerage is the equivalent of adding approximately 1 to 2% to your effective annual return through tax savings alone, which over 30 to 37 years of compounding represents a genuinely significant improvement in your final outcome. A 1% annual fee on a growing portfolio sounds trivial, but over 37 years on a portfolio targeting $1 million, it costs you approximately $400,000 compounding, meaning the difference between the $1 million target and what you actually arrive at is almost entirely explained by the fee choice you made at the beginning. The 0.03% expense ratio of VTI versus the 1% average expense ratio of an actively managed fund is not a small technical detail. It is a 400,000 decision over a 37-year accumulation period on a $500 per month systematic investment plan. Boring and cheap will always beat exciting and expensive over long enough time horizons, and the compounding math on fees makes that conclusion unavoidable for any honest analysis of the data. This is the complete framework for building $1 million silently while everyone else chases trends in 2026 and in every year that follows. Start as early as you can, contribute as much as you can, keep fees as low as possible, use tax-advantaged accounts first, automate everything, rebalance once per year, ignore headlines, and let 37 or 28 or 21 years of boring compounding do what they have always done for the investors patient enough to let them. That is the formula, those are the real numbers, and that is the complete honest picture of what silent wealth building actually looks like in practice without the shortcuts, or the excitement that most finance content uses to keep you clicking. See you in the next video, and until then, stay silent, stay consistent, and keep the math working for you. One more thing I want to be explicit about before this video ends, because I think it is the most practically useful piece of information I can give someone who is genuinely starting from zero right now in 2026. The first year of investing feels almost meaningless because the numbers are small and the gains are tiny, and nothing compounding produces in its early stages looks impressive compared to the projections at year 30 or 35. In year 1 of a $500 per month contribution at 7%, you have approximately $240, and you have earned roughly $220 in compounding returns. That $220 gain on your first year feels almost insulting compared to the $70,000 of annual gains the same portfolio is generating in year 35 when the balance has grown to near $1 million. But year 1 is the year that matters most, not because of the dollars it produces, but because it establishes the system, the habit, the automation, and the psychological identity of being an investor that everything which follows is built upon. The $1 million investors who got there consistently report that the hardest part was not managing the large portfolio in the later years, but simply starting and maintaining the habit through the first few years when the results felt completely invisible and discouraging. If you are in those early years right now, or if you are about to start, the most important thing I can tell you is that the invisibility of early compounding is not a sign that the strategy is not working. It is simply the mathematics of exponential growth doing what exponential growth always does, which is appearing almost flat in the early periods and then accelerating dramatically in the later periods in a way that feels almost impossible to believe until you are actually living it. Stay with it through the invisible years, and the visible years will take care of themselves exactly as the mathematics promises they will. That is the complete message of this video. That is the complete framework for building $1 million silently, and that is everything I want you to carry with you as you close it and return to the practical work of building your own future. Subscribe for the next video, stay boring, stay consistent, and let the math do what it has always done. The most important number in your wealth building journey is not the number in your brokerage account today, it is the number of months you have been contributing consistently without interruption. That streak, maintained through bull markets and bear markets, through exciting trends and boring sideways years, through every moment when a different path looked more appealing or the current path looked broken, is the single most reliable predictor of whether you eventually cross the $1 million threshold. The trend chasers break that streak every time a new narrative appears more compelling than boring consistency, and every break resets the compounding clock in ways the projections never fully capture. The silent investors maintain the streak because they understand that the streak itself is the asset, not any particular investment within it. Your job starting today is simply to begin the streak if you have not, or to protect the streak if you have, because everything else that compounding mathematics promises you over the next 20 or 30 or 37 years flows from that single foundational commitment to uninterrupted systematic investment. A Spartan warrior standing in the pass, and an Apache pilot hovering above. Now let me give you the rule of 72 applied to your specific situation one final time as a practical tool you can use right now with whatever starting point you have today. If you are 30 years old and invest $1,000 per month at 7%, you will have approximately 1,270,000 at age 58, crossing 1 million at age 56, with 17 years still remaining before traditional retirement age. If you are 35 years old and invest $1,000 per month at 7%, you will have approximately 81,000 age 63, and approximately 1,000,000 is exactly the goal reached. If you are 40 years old and invest $1,500 per month at 7%, you will have approximately 870,000 years old and at age 65, close enough that any employer match or slightly better returns pushes you across the threshold. Every single one of these paths requires nothing except a decision made today, maintained systematically for the years that follow, and protected from the trend-chasing behavioral patterns that derail the majority of investors who start with similar intentions but abandon the boring path when it stops feeling exciting. Make the decision today, automate it tomorrow, review it once a year, and leave it alone for everything in between. That is the complete roadmap to $1 million built silently, built boringly, built with mathematical certainty over whatever timeline your starting point and contribution rate allow. See you in the next video. The 4% behavioral gap that Dalbar documents year after year between what the market returns and what the average investor actually captures is not a small technical detail. It is the difference between 1,037, 37 years of identical monthly contributions. Closing that gap requires nothing except consistency and the decision to not let any trend narrative, any market crash, or any exciting new opportunity override the boring systematic plan that the mathematics of compounding has already designed for you. Keep the system running, protect the streak, and let the math do what it has always done for the investors patient enough to stay out of its way. Start today. Stay boring. Build silently. See you in the next video. The mathematics is patient. The compounding is relentless, and the $1 million outcome is waiting exactly where the data says it will be for anyone willing to be boring enough to collect it. That is the complete honest truth about building wealth silently while everyone else chases the next trend. And it is the only truth that has consistently produced real outcomes for real investors across every market cycle in the history of modern investing.